Good morning, good afternoon. Welcome to the Refinitiv webinar, How to Predict Market Performance with News and Market Sentiment Data. My name is Teresa Halsey. I am a Customer Success Manager at Refinitiv, and I'm joined today by Anthony Luciani, a Quantitative Analyst at MarketPsych. With us is also my colleague, Ronak Patel, who is a Solutions Consultant at Refinitiv. Before we get started, there are just a few housekeeping items I would just like to mention to you. Click the media player on your screen to enable sound and video. Your microphones are muted. Please submit any questions that you have in the Q&A box, and we will answer these at the end of the session. We will try our best to answer as many questions as possible. However, if we're not able to address your question, we will certainly follow up with you via email. The session is being recorded. The link to the webcast will be emailed to you following the session, and you can find the slide deck along with other helpful links in the resources section. Lastly, before we get started, we are always seeking ways to improve. So we would truly appreciate if you complete a short survey following the session and provide us with any feedback for future. With that, I'll turn it over to Anthony.
Thank you, Teresa. Hi, my name is Anthony Luciani. I'm a quant researcher at MarketPsych Data. I'm with Teresa here and Ronak, and today we'll be covering some market relations with sentiment data and some interactive Jupyter notebooks, as well as some polling questions to get an idea of where people stand on this material. Because over the years, it's slowly become more and more acceptable as an alternative source of data. And what we really want to do is illustrate its utility and demonstrate its predictive capacity across multiple asset classes. So one short example to start us off with is the US-China trade war. In this slide, we can see the, not sure we can do that. I've got those slides, guys, don't worry. So the sentiment for the US-China trade war is essentially a, sorry, one second, this presentation is, I'm not sure if it's multiple of us moving it, but I'll handle the slides. Okay, so here we have the US-China trade war, and it looks like the slides don't want to display. So in fact, let's just go direct into the overview of what our background is and where we're from. So at MarketPsych, we're behavioral finance experts, or at least we try to be, and we're of the school of thought that people are irrational, people have emotions within them, emotions are present across the animal kingdom, in humans, even down to the most primitive life, including amoeba, which are an example of just very simple life. And in fact, when we analyze the behavior of amoeba, we can categorize it into particular emotions. And these emotions are associated with particular actions, and fear, for instance, corresponds to retraction. Anger corresponds to destruction, and joy and trust correspond to promoting bonds and repeating tasks. How does this intersect with financial markets? Well, in behavioral finance, we try to explore those biases, those human biases, and quantify risk perceptions. And sorry, the slides are a bit buggy here, but guys, can we? Here we go. All right, there we are. Sorry. So in behavioral finance, we're aware that people are systematically non-rational about their risk. And the two main overarching themes that people use to describe these irrational behaviors are overreaction, which is extreme overreaction to stimulating events, for instance, an oil pipeline being blown up, or underreaction, where people don't immediately price in the known value of content in text or an event. And non-sentiment analysis forms of this pattern can be described or can be found in PEAD, post-earnings announcement drift, where we see the information contained in an earnings announcement not fully be incorporated into an asset's price the moment the earnings comes out. And in fact, there's this momentum, this trend effect following a positive or a negative earnings announcement after its initial release, which corresponds to the content of the earnings announcement. So that's an example of underreaction to the news as it comes out. At MarketSight, we're trying to quantify exactly the content of the news, and we're quantifying these risk perceptions and the information flow determined by online social media, online news media, investors, the market. And obviously, the goal is to predict, it's to create some predictive models out of this, and we have some examples of this today. But what we're really doing is trying to provide a simple quantification of sentiments and themes and topics for a given entity over a given period. So I believe we have our first question here, our first poll question, which is, which schools of thought do you primarily identify with? You can choose more than one option. In this case, I would probably pick behavioral finance, but for instance, traditional finance includes those with a CFA background, Teresa, those with perhaps machine learning are interested in imposing structure on their data by just choosing the best fitting models. Those from a technical analysis background may be more interested in selecting their own charting tools for a given period of time. And econometric research, especially favorable among academics and econometricians in general. And yeah, if you don't feel like you belong to any one of those, or you have another one, select other or not. So we'll give it about another 10 seconds on that, and we'll take a look at the results. Teresa, do you fall into the traditional finance beliefs? Okay, right, let's take a look at the results. And yeah, most people fall into traditional finance. Some people in a surprising amount of technical analysis, and a lot of people believe in the strength of machine learning. I do too. It's just that, well, every individual school of thought has its utility, and its utility appears at different points in market efficiency. So it was just good to see the demographic of the people here today. And yeah, so what we're really doing at MarketSight is pulling out references to specific themes in the media. For instance, fear in coronavirus, infected markets, not just from news media, the New York Times, MarketWatch, Reuters, but also social media as well, putting out implicit and explicit references to these themes, these emotions, these topics that we can then hopefully use to correlate with some extra factor. One example of a previous version of this NLP engine that we have at MarketSight is displayed here, and we have a short demonstration of what this model is doing. So in this sample statement, crude oil production was disrupted following attacks on Libyan oil markets, stoking fear of a supply disruption and sending crude oil prices higher. We can see, for example, that we're pulling out references to economic conflict in Libya, as well as economic instability. We're also pulling out disruptions to the production of crude oil in Libya. And we're not just pulling out this large taxonomy of happenings, but we're also pulling out the tenses, and a lot of other NLP tasks are obviously going into this, entity detection, name sense, word sense disambiguation, sentence dependency parsing, who is talking about who, which is the subject, which is the object. It gets very complex very quickly, and it takes a lot to get high quality data. And we're hoping that we've at least achieved that. We've been publishing this data through Refinitiv since 2011. So we have quite a long history. And speaking of history, this data set does actually go back to 1998. So it allows people to test over at least 3 major business cycles. And it's available for every asset class, because wherever there are markets, there are people. And wherever there are people, there are these biases. So that includes currencies, cryptocurrencies, commodities, equities, fixed income, and commodities, yeah, as I said. So we are pulling out specific emotions and themes, which will be displayed soon. And we're deriving all of this, this quantification of sentiment from the top 2,000 financial news websites and 800 social media websites. And these are being aggregated into news feeds and social media feeds separately, and they're available on a minutely, an hourly, or a daily frequency. So unlike the unstructured text you get from a randomly occurring news article at a point in time, or a randomly timed social media tweet, we're rolling it into a much more usable time series data set, which allows someone to easily plug it into their models. So this data is, of course, released to quite a few different customers, from high frequency, with their high frequency users, down to much slower moving averages. And I believe we'll be taking a look at those slower moving signals today, because they're slightly more accessible for most people. Some of the themes we are putting out of the text are shared among all asset classes. As you can see at the top here in the shared fields just below the asset class name, we can see, for instance, the sentiment is a ubiquitous term. Optimism, which is a future tense subset of sentiment, it contains all expectational references to the media. Then prime dimensions of emotion, such as fear, stress, surprise. But also, within each asset class, we've curated themes that investors and researchers have deemed themselves as the most important topics for each asset class in driving the underlying asset's behavior. So, for instance, for equities, we can see references to analyst ratings, references to the earnings forecasts coming up, the fundamental strength of the company, the strength of our fundamentals, references to layoffs and litigation, or potential mergers coming up, and more reactive components such as long-short or just the sentiment in general. And along with other currency classes, we have things like the currency peg instability. And for countries, we have references to economic growth. So how does this all look? Well, we're about to show you. But in fact, continuing on from the question of which school of thought do you belong to, I'm going to pose now a question to everyone that's in the poll. And the question is, pick a number between 1 and 100. And you'll win the $500, there's no gift prize. You'll win if you pick the number which is closest to 2/3 of the average of everyone's number. We have a sophisticated quant team standing by to calculate the answer to this once everyone has picked their answer. And I'll give you a little time to calculate your best answer, but give it a shot. Teresa, which would you pick?
Let's see.
I would go with 30, personally.
30's a nice answer. Yeah, I see. Oh, people are changing their answers. All right. We're going to have to close this pretty quickly. Please submit your suggestion. So I'll give them 10 seconds on this because it's a relatively sophisticated one. And in fact, when we dive into potentially some reasoning behind someone might pick a particular number, you could start off with, for instance, asking yourself, what happens if everyone picks 100? If everyone picks 100, I'm going to show the answers now so that no one can change. If everyone picks 100, then the average of 100, because everyone's picked 100, is 66.6, and the closest number to 66.6 would be 70. So everyone picks 70. But that's the point. If everyone's picked 100 and I pick 70, I've won. But even if there's one more rational player out there, then they pick 70, and the average number starts to lower again. And being a rational player, I'm going to pick the lower number. And likewise, maybe the other rational players are also going to start picking lower numbers. And eventually, if everyone's rational and if everyone knows everyone else is rational, then eventually the best solution is to pick one, or in fact 10 in this specific case. But in the case where we have an unlimited number of choices between 1 and 100, the best answer is 1. Because if everyone picks 1, 2/3 of 1 is still 2/3, and essentially everyone wins, which is called, in game theory, the Pareto optimal solution. But not everyone is rational. And there are many people that have maybe picked 100, maybe picked 70 in this case, or 30 in Ronak's case. And because everyone's irrational to some degree, in the presence of this irrationality, you have to determine the levels of thinking of everyone else in this question or in the market. And this is just a good example of how the levels of irrationality that other people are exposed to or are inherent in those other people impacts your own choice just by their presence in the market or in this game.
So I believe the 2/3 of the average would be 30.072. So whoever picked 30 would be the winner.
Congratulations. Thanks, Ronak. You did it. All right, so that's just a good example of how people being irrational influences the market's behavior and the game's behavior. So going back to the data set, it is essentially a time series. So in this example here, we can see currencies data for the 14th of September, 2020. And here we can see, for instance, the Canadian dollar. And over that past 24-hour period, finishing at 7:30 p.m., we have an average count of the number of references to the Canadian dollar is about 303. And net, 3.6% of them are positive. And we have these other indices such as optimism, joy, price direction, and so forth. And these are all divided by the number of total references divided by to the entity, so that cross-sectional comparisons among entities can be made much easier. For instance, the Chinese yuan clearly has more buzz over the given past period. So if we normalize by the buzz, it makes cross-sectional comparisons a lot easier. How does this data look when visualized? Well, we've already seen, well, we tried to see one example, but we have many more. For instance, here is the Turkish lira buzz surrounding the Turkish lira in around August 2018, which is when the debt crisis reached one of its peaks, and included, you can see the Turkish lira currency dropping quite significantly against the dollar. There are other visualizations you can create out of this data set, not just for appealing presentation, but also because they do have a level of predictability behind them. These are two examples for currencies. So we've ranked currencies on the left by their price forecast index, which is an average. Well, in this case, we've averaged the price forecast index values over the past 7 days and produced a ranking. So Swedish krona, in this case, is the highest. And likewise, on the right-hand side, we don't have to make these cross-sectional comparisons. We can look at the individual sentiment for one company, maybe construct some moving averages out of it, and find some potentially, well, some visually compelling results as well. And we'll actually be showing this in one of the Jupyter notebooks coming up. So on this data set, we do have around 55, well, more than 55 academic papers. Some have been published in rather highly accredited journals, including the Journal of Portfolio Management. And we do also have 3 books written by Dr. Richard Peterson on this data set, the most recent of which is called Trading on Sentiment. And that's actually taking known psychological biases from that literature and exploring them in financial markets using this data set. So it's a good handbook, not just for the data set, but also for psychological biases and how you might be able to explore them. Well, one of the penultimate questions here is, which of the following sources influences your beliefs about market events and market structure the most? So it could be short-term events, or it could be long-term events, whatever you think influences your beliefs the most. So academic journals are useful, financial textbooks, your big CFA tomes, but also maybe you've been reading on some opinion pieces or some informative pieces from the Financial Times or the Wall Street Journal that have influenced your decisions. Or maybe you get your information from Twitter or Wall Street Bets, which is equally as informative sometimes. So give you 10 more seconds on this. Ronak, where did you get your information?
Social media and Wall Street Bets is a good resource, I think, for sentiment for some Robinhood traders, for sure, at least.
That's true. That's very true. Okay, and the results are in. A lot of people are getting their information from financial news, which is good, keeping with the times, with some degree of integrity, and some from social media. And the theory backing it all up supposedly is contained within those financial textbooks and academic journals. So some of the examples of the research on this data set include that from Stan Beckers from AQR, detailing or comparing social media sentiments to financial news media sentiments across time and their correlation with the next month's MSCI World Return Index. So you can see, in fact, orthogonal value is derived from social media and equity news and financial news, and it changes over time. Which hints at the lack of hints at the adaptability of the market to given information. On the right-hand side here, we actually have a feature constructed out of this data set called sentiment shock, and we've analyzed what happens to the VIX in response to sentiment shocks. And we can see at the top subgraph that there's quite a clear response of the implied volatility following a sentiment shock, lasting quite a long period, and you can see the confidence intervals are quite far away from zero, which does provide a strong indication that there is a significant shock. Likewise, on the second graph down below, we can see a positive response in an asset's return given a sentiment shock as well. And these papers are all available through our academic journal, through our academic research portal. And finally, one example external from this year by Hyman and Co. is based on currencies. And they had some really high R-squared values of around 4.45 and 9.03 in sample and out of sample. And what they did was they took a look at comparing currency returns, currency factors, interest rates, macro fundamentals, and the market sentiment, and took a look at which were the most predictive factors in the currency excess returns prediction. So if you have any questions on this data so far, please do go ahead and pop them in the Q&A box, and we'll be answering them towards the end. So one of the more intuitive relationships in behavioral finance is displayed in this graph. What I've done here is ranked US stocks by their past average 30 days of sentiment values. I've ranked them, grouped them into deciles, and the top 10% of stocks by their sentiment values, the most positively perceived stocks, are grouped into the 10th decile, and the most negatively perceived stocks are grouped into the decile 1. And then I've observed the average price drift of these groups moving forwards, and we can see clearly a spread between the decile extremes, between decile 10 and decile 1, increasing up to 90, 100 days into the future, given this small ranking over the past day 0 to minus 30. And we can also see a very clear correlation between the stock's sentiment and its returns. And this really is capturing one of the most intuitive relationships, because what it's saying is that positive perceptions manifest into positive returns or value in a company. And this we see across asset markets as well. Less so when stocks or an asset class entities are less comparable, but we see it validated across markets as well. So for instance, we see this in China, the United Kingdom, Australia, pretty much every country we plotted on. And what this means is that when you do take a cross-sectional average of stocks, for instance, here, and we've colored stocks according to their sentiment value, this does actually provide some research and some significance behind this heat map here, which is that, for instance, Fiverr should be expected to outperform Boeing over the subsequent 90 days, and this is an average from October 1st, so it should still be valid. But of course, this research was taken over thousands of stocks across back to 2006, so it's a very large sample set, and it has been validated though, so that's great. And one final example of internal research is the high innovation stocks. So what we've done here is rank stocks by their innovation, held a portfolio based on the past innovation from the past week, and held these stocks moving forwards. And we can clearly see that compared to the total return from the S&P, which includes dividend reinvestment, that this portfolio of the top 100 companies ranked by their innovation outperforms it quite significantly over time. We have an exponential y-axis, and when we actually condition the return on the segments of the S&P growth, we find that this strategy does not perform as good during the S&P decline periods. And one of the potential reasons for this is that what do you associate with innovation? Novelty, something new, potentially untested, untrusted. It's not stable yet. And as such, during times of economic instability, you do want to move into safer assets and safer securities, which is potentially why the portfolio doesn't perform as well during times of economic downturn, or market downturn at least. And similarly, we can construct portfolios of assets based on their management trust index. So here we've taken a daily portfolio of the quintiles of stocks ranked by their management trust, and we can see the most positively perceived assets in the media moving forwards outperform those most negatively perceived in terms of their management trust. And likewise, another ESG-themed index is anger, because what do most controversies within the ESG space have in common? Outrage, public outrage, anger at a given company. And we can see here that the most negatively perceived companies by their anger, the ones that people are the most angry against, underperform against the rest of the markets, the assets in the market. No transaction costs are included in these examples, but it's really just a good demonstration of the correlations, not a tangible portfolio. Otherwise, we'd be demonstrating the portfolio accurately. So these cross-sectional comparisons don't have to be made. We can instead make moving averages. And what I'm going to do now is skip from these moving averages into one of the interactive notebooks and give some demonstrations on how this data works. So one of the moving averages we can construct, for instance, for crude oil is displayed here. What we've done is we've plotted in orange the continuous front-month future contract for oil, and we've also plotted two moving averages of sentiment and shaded when the short-term moving average is above the long-term moving average. So there's a 30-day moving average and a 90-day moving average. And this shading represents excess positivity or negativity. And it might not be clear from this graph, but there are clear correlations to crossovers in the sentiment corresponding to crossovers in the market drawdown. We can see here, for instance, around September 2014, that there's clear correlation between the underlying data set and the sentiment. When we actually try to make something out of this through using these moving averages explicitly, we can actually construct a strategy, for instance, using these Jupyter notebooks. And I'm going to go ahead now and share my screen just to demonstrate how this goes about. And this is available in our sandbox environment for anyone who's taking out a trial on the data set. And okay, let me just get this loaded up. So here's that same example of, in fact, this is the example I couldn't show you at the start. This is an example of the US-China trade war and the sentiment around it over the past 4 years. And we can see clearly a correlation between the sentiment about the Chinese yuan and its underlying asset value compared against the dollar. So actually, now we're going to demonstrate a strategy built on top of that crude oil example, where we saw the moving averages coinciding with the market with the oil price drawdowns. So here we have our imports, and we have some just text explaining what's going on here. What we're doing is fetching the data from our environment, and as you can see here, it's come in this time series format with the data type, news, social, and social media, all separated out. And if we want just one particular feed, then we isolate according to the feed we're interested in. So in this case, I believe we're looking at news. We're also going to download the daily price data for that future month contract, that from month contract. And we're also going to isolate the data because this is hourly data. We're going to isolate it 1 hour before the crude oil price is available. So it allows us to potentially take a position if we need to in that time. And when we plot this data set, we can see that initially there's not too much clear correlation. These are the daily values of the sentiment along with the continuous price, the contract price. And over a large period of time, 2006 to 2019, we can see some correlations, for instance, during these large peaks and troughs, but no discernible pattern. And this data set, due to the nature of its volatility, we do recommend maybe constructing some extra feature out of it, maybe using a distribution of recent values. And the complexity you can go to is endless. You could go, for instance, using moving averages. The next step would be Kalman filters, or the next step beyond that would be LSTMs. But we're just going to use moving averages here and demonstrate that using a 30-day and a 90-day moving average, we can construct slightly more meaningful features. Here's what we've done. So we've averaged it according to a nice 30-day moving window across time, shaded it, and when we plot it against the underlying entity value, still not too much clarity, but actually, like with the original graph, when we exit the market, when there is excess fear or sentiment, I can just change it to sentiment actually. So we get our moving averages. We can see that, it's not too clear in this graph, but there are correlations between the drawdowns in the sentiment and the underlying asset price. And for instance, when we construct a very basic strategy, which only holds the asset when the short-term excess sentiment is positive, we can actually see, for instance, this red line representing that strategy has a significantly lower volatility than the underlying crude oil front month contract in blue. And there are some other examples of the short-only strategy and the long-short strategy extracted from this. And of course, if you do impose a stop loss based on any random criteria, if you pick a random number, then any strategy will have a lower volatility than the underlying price. But what we can see here is that the returns are higher. Not that we're implying that you should use this directly. Of course, it's very parametric, just using a 30-day and a 90-day. There are things to optimize and cross-validation to perform, but this is a good example of how the sentiment data can allow you to at least de-risk when fear is high or when sentiment is low. Okay. So we're also going to move on to an example of another feature construction from this data set, which is called filtered sentiment. And this is based on the common notion that a lot of media commentary about a given asset is just that. It's commentary. It's reactionary comments about a given entity's price changes and behavior of recent events. And we've explored this somewhat and found that, well, when you try to construct a model to explain the current day sentiment based on the past day or the past events of the market, that you're left with, what you can end up doing is explaining a certain component of today's sentiment by the past price action of an asset or an entity or a currency. And when you construct a regression, for instance, you can determine an error term unexplained by that regression. And the error term, which is what we call novel or unexplained sentiment, is actually more correlated typically with the future asset returns than the raw data itself. So that provides someone who wants to construct a useful feature out of this data set based on simple behavioral finance, just an idea, really. A stimulating example. And here, for instance, we have the regression. We're not just using past momentums, we're also using the 10-year T-bill rate, the VIX, the dividend yield for companies, and so forth. Oh, so the dividend yield for the S&P. So the correlation between the S&P's next day return and this day's sentiment that's raw, unadjusted, and the sentiment that's filtered according to removing that reactionary component, you can see here that, in fact, the raw sentiment is not so correlated. But as soon as we remove that reactionary component, we get a very nice correlation, a significant correlation. So there's clear motivation here to explore this further.
Hey, Anthony, quick question.
Hey, Bruno.
Based on your experience, I know just above we saw that you incorporated VIX, 10-year Treasury yields or Treasury bills as other data that you incorporated with this market sentiment. Are there any other fundamental variables that you find work well when paired with market sentiment?
Right. So from the traditional behavioral finance, from the traditional finance perspective, there are certain factors that explain returns. The CAPM regression or the 5-factor regression, and these can be useful. And we do like constructing abnormal returns from them and then trying to explain those with the remaining sentiment we have. But in combination with sentiment, we do see improvement when adjusting for the size of a company as well as its past return, as we can see here, the momentum factor. So that is certainly motive to explore size factor and a momentum factor from an asset. Otherwise, it really can be just due to the complexity of your hypothesis, your idea, or the model structure that you impose.
Right. One more follow-up on this.
Yeah.
Oh, sorry, go ahead. Oh, yeah. One more follow-up on this notebook that we just saw here. We saw that filtered sentiment has stronger correlation strength than raw sentiment. Should our users aim to primarily use filtered sentiment over raw sentiment every time? Or are there some instances that you've seen where raw sentiment maybe be more useful?
I think that really depends on your own hypothesis and what you're trying to predict, what time horizon you're interested in, really the whole scope of your project. For instance, if you're using an LSTM, which is a complex machine learning model that accounts for trends, both long-term and short-term, then part of this reactionary component is already calculated into the features within the model. So if you can define your model parameters correctly through sufficient amount of cross-validation, then it's possible for you to skip a filtered sentiment aspect. But again, the raw sentiment is just as useful. And in fact, what I haven't included here is that the reactionary component of sentiment is just as useful as well. So despite the filtered sentiment having a high correlation, even the reactionary component also has a high correlation with next day return, despite only being trained on the past momentums of an asset. So this component analysis is a useful tool, but it's not necessary at all for you to find value, as we saw with the simple correlations between the sentiment values and the subsequent returns of an asset. Likewise, with the daily rankings, we find sufficient value just out of the box, essentially.
Thank you.
Good question. All right. So the final example for this data set is actually just to help people, I guess, from a machine learning background. What we're doing really is exploring which of the features or which of the indices, topics, themes are most correlated to the SPX, the S&P returns. And in this, all we've really done is construct a visual for a a simple decision tree fit to the data, along with with sentiment data from news and social sources. So we've downloaded the data from our API. We've downloaded the S&P data, and we've actually set some in-sample years in this, but really you have some idea at least of the complexity of cross-validation and in-sample and out-of-sample periods and what they require. So there's a level of sophistication that you would use when you're actually employing a machine learning model would be far more than this, but it's a good demonstration. And what we're left with in this example, after fitting a decision tree, which tells you which of these features has the most impact on the asset's behavior, the asset's underlying returns, we can actually see that here bond sentiment has the highest impact on the S&P 500 returns moving forwards. And second to bond sentiment is the index rates buzz. Even interest rates buzz. And third to this, we can see references, topics such as trust in the stock index and bond price forecasts. And slowly, you can tune this model this tree to have 50 different layers. But in fact, even in our own testing, we found that going beyond a level of 3, a depth of 3, is overfitting to typically. So this does provide at least some idea of feature generation or feature selection, but then perhaps if you were to then use those features somehow else in your own neural network or something of your own hypothesis, then even just to select a subset of features to consider generating some ideas around. This is a good example. And the screen share. So that was one example. Now, 3 examples of useful Jupyter notebooks. And finally, I believe we are going to now open it up to a Q&A, which we have some questions from the audience from waiting. So I'll hand it over to you, Teresa.
Thank you so much, Anthony, for that insightful presentation. We do have a few questions, and I would just like to remind folks to enter a question. Please click on the Q&A box. The first question is, what is the difference between the data you are presenting and what I would receive from the ICON API?
Okay, so our data is not explicitly available in ICON. What you have seen from us is the ICON app, which we do have available. It's freely available on ICON. So if you have ICON, you can go and log into this right now. In fact, I'm just showing it here. So you can plot all of the charts you've seen today by yourself, at least the interactive ones. And you can get some good examples of, for instance, currencies or commodities data and visualizations that typically provide they're good for idea generation, but this data isn't available through ICON. So how it's available to people is they take out a subscription, trial the data, and then test it themselves. And if they like it, they subscribe to it. And they get a sufficient amount of history to test over. And yeah, that's the scope of it. It's available through FTP and SFTP.
And this question might be somewhat related. Can I retrieve the market site sentiment data with regard to a certain firm or stock through the ICON Python API?
Right, so the Python API is actually on our own servers. It's not on ICON. So you can actually use it to construct the things you've seen today. You can get the example notebooks we've been demonstrating today, and you can play around with the data yourself through the sandbox. But on ICON, the only thing that's available to you is the free MarketSight app, which has those visualizations I've just demonstrated. And that is, again, quite a useful tool. If you're not using a large quant, if you don't have large quant tools, it's still very compelling to explain, for instance, what the sentiment of the given day is. And we've seen very high correlations with the underlying asset price and the sentiment. And this slide is one demonstration of that. So, yeah.
Okay, the next question is, how do you define innovation and advance? Is it just the word that's used in a release, or the fact that others describe it that way? So the question is, how do you define innovation and advance?
Right. So in advance is a key component of this data set because we're not fitting it to any past price data to make it seem more predictive than it is. This model is tuned to the fidelity of the natural language. We want to make sure we're accurately pulling out the right levels of innovation or references to innovation in a text rather than make it seem predictive by intersecting it with past price data. So in that sense, innovation is defined by specific themes and references, a lower level taxonomy other than the word innovation. For instance, things referenced as next gen or novel, new, small themes like that, implicit references to innovation. Whatever we can, we've been trying to include into this model over years in a hierarchical taxonomy of things which eventually get rolled into that innovation index. So including things like when someone says something is outdated or not innovative, that also gets rolled into the innovation index.
Next question. Is the use of market psych data in Jupyter Notebook included in the Icon Premium subscription, or does it require an extra fee?
The data is only available through initial trial and then subscription, which is independent of Icon. So unless if you have Icon, unless if you are willing to take out a trial in the data, you won't be able to access it through Icon. Apart from if you can take a look at this app, which is just purely for the visualization, you can't download the data through Icon.
And we may have touched on this one. What is the difference between the data you are presenting and the one that we would get from the Icon API? I believe
it's essentially the same data, except we've applied some moving averages to it. So for instance, in this chart, we actually have an example of the Human Infectious Diseases Index for China and European countries. And you can see all the way back in, December of last year, the Human Infectious Diseases Index for China was increasing, so at least a lot around January. And that's the raw data in these bars just below the lines of the airline stock values. But the transformations that we apply in the Icon app are moving averages typically and averages over periods because it smooths out the data. And sentiment data is typically very noisy. It's like as noisy as returns data. So unless if you have some kind of feature engineering out of it, then you might struggle to find some value in it. But as you've already seen, it's not too complex to extract features out of it.
Can we get the example notebooks?
If you have a trial to the data set, you can. The notebooks wouldn't be very useful if you don't have a trial to the data set.
And is the feed available in real time?
Yes, of course, yes. So it's all available minutely, hourly, or daily, depending on the frequency you're interested in.
What is the difference between this work and Refinitiv Sentimine?
This work and Refinitiv Sentimine. Is Sentimine a product, or are they referencing the StarMine product?
I believe they are referencing the Sentimine product that's provided via Refinitiv Labs. So I don't know if you are familiar with that, Anthony.
No, I think that sounds relatively new to me.
Okay, we can circle back and provide an answer to that question, but the Refinitiv Sentimine is a different product that's available and being developed by our Refinitiv Labs. So it's independent of the work that you're doing at Market Psych, Anthony.
Okay, just like the tRNA.
Okay, I'm just scanning. I think that we have covered all of the questions. And again, if by some chance we have bypassed your question, we will certainly follow up with you via email. Thank you all for joining this live event. We do invite you to request a 30-day complimentary access to the Refinitiv Market Psych indices. You can use the free trial window box that's next to the Q&A section to request that particular trial. And we also would invite you to go to our site called solutions.refinitiv.com/academy to view courses that will be available provided by Refinitiv and other areas. So go ahead and visit that site just to schedule any upcoming training sessions with us. And again, we will be closing this session with a survey that will pop up at the end. So please go ahead and fill out that survey. We certainly appreciate your feedback. And if there's nothing else, Anthony, that you would like to add, I think we can conclude the event.
All right. Well, thank you, Teresa. Thank you, everyone, for listening. You can reach out to us. Sorry, go ahead. Oh, right. Yeah, so you're free to reach out to us at MarketPsych or everyone at Refinitiv who's been presenting today. And we'll answer your questions via email or follow our LinkedIn page. We have a couple interesting posts there every month, every week or so. And yeah, I hope you've enjoyed it. I hope it's been informative. Thanks, Ronak, and thanks, Teresa.
Thank you. Have a fantastic day. This concludes our event.